what did he mean when he said, "Make America great again"? And I think that that means a lot of different things to folks. Because there's a lot of social issues on the table, and I'm not going to talk about those. But if you look at that chart up there, and it's a little tough to read, but if you look at the wavy line, what we're showing you is the GDP growth over the past half a century. And if you look up to 2000, we had a growth rate of about 3.5%, technically 3.4%. And in 2000, something fundamentally changed. And that growth rate slowed down such that we've really been averaging closer to about 2%. If you go in most simplistic terms, make America great again, and if we take out all the social stuff and the things that these guys will talk about, make America great again, perhaps we could get back to a growth rate, our natural growth rate of 3.5%. Let's challenge that. What I'm showing you here is the 2017 federal budget, and you can see that we have a budget of about $4 trillion, and you can see the components of it. If you look at the spending side, you're going to see roughly half of that budget, bless you, is spent on Medicare, Medicaid, and Social Security. Roughly half. We're going to delve into that a little bit further, but if you look at the sources of financing, you can already see that we need to borrow about 14% every year to meet that budget. Well, let's get a little bit more granular. This I pulled, by the way, right from the CBO, the Congressional Budget Office. I have data that we use, but I thought I'll show you what Congress is using. And if you look at that chart, you can see up to 2017, you can see, and well, actually maybe you can't, it's a little tough to see, but this is a chart showing expenditures for those two components up through 2017, and then a projection going forward. And if you look at relative to GDP, the prior chart I showed you was relative to budget, not GDP. This is relative to GDP. And today it's about 6%, a little less than 6% of GDP to pay for those components. But if you fast forward another 30 years, it becomes 10% of GDP. That number is never going to come down. It's forever going to go up. So it would be really, really nice to have a higher growth rate. If we could accelerate economic growth, this chart doesn't look so bad. But here's what it's going to do based on current projections. I'm showing you the budget from 2017, and you can see a fairly modest budget deficit. And by the way, budget deficits, if they are modest and don't exceed budget deficits, if the deficit doesn't exceed your growth rate in GDP, your nominal growth in GDP, you can run perpetual deficits. Deficits are not problematic if they are modest. They are not going to be modest going forward. They're going to become about 10% of GDP going forward. You probably already know where I'm going with that. Here's a chart showing federal debt. Anybody like to look at that chart? Mm-hmm. The only solution here is to grow faster. Our deficits are going to mushroom. Our federal debt is going to mushroom based on all reasonable forecasts. The only solution is to grow faster. But is that an actionable policy? Well, I'm going to give you some insight into the markets, and we're going to back into the answer to that question. The chart I'm showing you here is a little busy, but it's actually worth taking a close look, because what I'm comparing, what I've drawn two lines are GDP growth and interest rates. And that is what you would call a highly correlated series in finance. Those lines follow one another roughly, don't they, over time? And where are we with interest rates today? At very, very low rates, right? By the way, I'm not going to really be talking about investing in the market much here, but I can tell you that it will be very, very difficult to raise rates substantively from here. I'll support that notion in a bit. But Those two are tied together. Low interest rates go with low GDP growth. And I think that that's going to continue for quite some time. By the way, I thought I would throw this one in here because it's fascinating to me. Here I'm showing you interest rates and basically earnings growth and GDP growth and how tightly correlated they are. There's a reason that stock performance, market performance, is also tightly correlated to economic growth. Economic growth is what we desperately need in every corner. Every policy, in Trump's mind, I think, has to do with stimulating economic growth. So, what drives GDP growth? If you look at that chart, you can see roughly 70% of GDP is consumption. You and me buying stuff, whether it's groceries or gas for our car or whatever. 70% of GDP growth is everyday consumption. Well, what drives consumption? First of all, I might suggest unemployment. And we've seen fairly low levels of total unemployment. We're now actually running below 5%. But this will be relevant to the folks in here because you are trying to serve many constituents that are underserved by federal programs, right? If we look at Hispanic and Latino, or we look at Black and African Americans, or 16 and 19-year-olds, we can see that unemployment levels in those groups are much, much higher. So that's a frictional drag to GDP growth, and it seems to me that nothing that has been proposed is really addressing those constituents. Let's talk about wages. Wages is another input into consumption, right? And for the most part, we haven't seen any improvement in real wages being net of inflation. It's starting to go up now, but people are really not ahead today relative to where they were a decade or 2 decades ago. Our ability to consume stuff today is roughly the same as it always has been. Real wages have not improved substantively over the long term. So, is that an actionable policy? Not really. We also have a demographic headwind. The baby boom generation, as you can see, is moving into retirement. The participation rate that I'm showing you here is basically the percentage of people over age 16 who are actually working, who are eligible to. And you can see that it's been falling, and it might have hooked up a little bit here, but until the baby boom generation gets fully into retirement, this number is going to go down. That's a frictional drag on growth. Personal savings rate, how much you save as opposed to how much you consume. That's an input into what drives GDP or consumption. And right now, it's right about where it ought to be, at about 6%. You could argue it should be higher than that, but when you have excess savings, that becomes a frictional drag to obviously consumption and GDP growth. Federal officials would love for you to buy more stuff and save less. Well, you and I know that that's not a good strategy. This is one of the inputs that must be considered. So people are not over-saving right now. They're right about where they should be. So we haven't had any improvement on unemployment for some of the constituents that you serve. We haven't seen any real improvement in wages. The demographic trends are not in our favor. The personal savings rate is about right. There's only one other area where you could get maybe some help from infrastructure spending, but what's not widely realized is that for there to be economic growth, there must be an expansion in credit. By definition, our economy cannot grow without an expansion in credit. And you can see that we have had a massive expansion in credit over the past number of years. That is an expansion in credit. And so you might say, well, okay, so we're supposed to get more growth from where? So it will be very, very challenging, and I'll leave the rest of my comments for the panel discussion and let us go into tax and legal changes.